Hey everyone, welcome back to Corporate Decoder. Today we're diving into a rather juicy filing from Florida Power and Light Company and its parent NextEra Energy. And let's just say there's some big changes brewing in how you'll be billed for your electricity. Get ready for a rate hike discussion. Alright, so what's the big news? Well, Florida Power and Light Company and its parent company, NextEra Energy, have filed an 8K report, which is basically a heads up about a significant event. The crucial date here is August 20, 2025. This is when the company, along with 10 groups representing customers, made a big proposal to the Florida Public Service Commission. This filing is all about a proposed settlement agreement that could change things for FPL customers for years to come. Think of it as a negotiation to decide how much you pay for electricity and what services you get. The main event, the core of this report, is a proposed agreement that aims to settle all the issues in FPL's current base rate case. What does that even mean? Well, companies like FPL have to go before regulators every so often to ask for permission to change their prices, their base rates, and this agreement is them trying to get that permission. This proposed agreement outlines some pretty key changes that would kick in starting in January 2026 and keep going for at least 4 years through December 2029. So this isn't just a small tweak, it's a plan for the medium term. And what are these changes? Get ready for some numbers. We're talking about increases in annual retail base revenues. First up, a hefty $945 million increase starting on January 1, 2026. Then another $705 million increase starting on January 1, 2000. So over 2 years, that's a significant jump in the money the company expects to collect from you. But wait, there's more. FPL could also get more rate increases related to solar and battery storage projects. These would come through something called a solar and battery base rate adjustment, or SOBA. This means if they build new solar farms or battery storage facilities that come online in 2027, 2028, and 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 20 storage projects are needed. Now, let's talk about how much profit they're actually allowed to make. The agreement sets FPL's authorized regulatory return on common equity, or ROR, to earn 10.95%, with a range from 9.95% up to 11.95%. They can ask for rate relief, meaning they can ask to raise prices again if they earn more than 9.95%, with a range from 9.95%. It can ask for rate relief, meaning they can ask to raise prices again if they earn more than 11.995%, to 11.95%, with a range from 9.95% to 11.95%. Any interested party can ask for a review to potentially lower rates. This is a pretty standard way regulators try to balance the company's need to make money with the public's interest in fair prices. The company's financial makeup, how much it relies on borrowing versus owner's money, is set at a 59.6% equity ratio. This is nothing new, it's consistent with how they've been structured before. Here's an interesting bit. They want to implement a rate stabilization mechanism, or RSM. This is essentially a pot of money up to $5.5 billion from certain deferred tax liabilities and leftover reserves. FPL can dip into this pot over the term of the agreement to help stabilize rates or meet their minimum profit targets. It's a way to smooth out financial bumps. Now, this part is good news for customers. FPL will pass on to you your share of the gains from their asset optimization program as those gains are made. Even better, if they make more than $150 million in gains in a year from this program, all of that excess goes back to you through the fuel cost recovery clause. This is a way to share the benefits when the company does particularly well managing its assets. When it comes to storm costs, which are a big deal in Florida, they'll continue to be recovered in stages. What's important here is a cap. For the first year of recovery, any surcharge on your bill for storm costs will be limited so that it doesn't add more than $5 for every 1,000 kilowatt hours you use. Any costs above that can be recovered in later years. This is a customer protection measure to prevent massive immediate price hikes after a big storm. And for those of you who track tax laws, if federal or state corporate income taxes change during this agreement period, FPL can ask to adjust rates to reflect those changes, but only after the Florida Public Service Commission reviews it. Finally, they're also looking at new pricing structures or tariffs, specifically for large industrial customers who use a lot of electricity, specifically those with new or increased loads of 50 megawatts or more. This seems to be about tailoring prices for very big energy users. It's crucial to remember that all of this is just a proposal. It will only go into effect if the Florida Public Service Commission approves it, and they've asked the commission to make a decision so they can start implementing these new rates by January 1, 2026. This sets a deadline for the regulators to act. Now, like many companies, FPL and NextEra Energy include a bunch of forward-looking statements in these reports. These are essentially educated guesses about the future, saying things like what might happen or we expect. They use these to warn investors about the uncertainties and risks involved. They're very clear that these future predictions aren't guarantees. Real-world events could easily make their actual results very different from what they're saying now. This is a pretty standard disclaimer, but it's important to remember that the energy business, especially in a place like Florida, is subject to many unpredictable factors. One major risk they highlight, and it's a big one, is the extensive regulation. This means government rules and approvals play a massive role in everything they do, and changes in those regulations can hugely impact their business. Another key risk is their ability to actually get paid back for all the money they spend on things like building new power plants or maintaining the grid. If regulators don't allow them to recover those costs and make a reasonable profit, it directly hurts their bottom line. They're also worried about government incentives for clean energy projects being cut or changed. This is a direct risk to their investments in things like solar and wind power. If those incentives disappear, or if new taxes or costs pop up on clean energy equipment, it could really hurt their plans and their profitability. This is a broad one, but crucial. Any new laws, regulations, or even executive orders could impact them. This means the political and regulatory landscape is a constant source of potential disruption for the company. Speaking of regulations, they also mention capital expenditures, meaning spending big money and increased operating costs due to environmental laws. So complying with environmental standards isn't just about being a good citizen, it's a direct cost that impacts their finances. And here's a very relevant one, the impact of laws or regulations that limit greenhouse gas emissions. As the world moves towards cleaner energy, these regulations can force companies to invest in new technologies or change their operations, which means more cost. This goes back to that extensive regulation we talked about. They face significant costs just to comply with all the rules, and there's always the risk of hefty fines or penalties if they don't get it right. Of course, there's the always present risk of lawsuits and legal troubles that could have negative outcomes for the company. This is a big one for infrastructure companies. If they can't build their projects like new power plants or transmission lines on time or within budget, it can lead to massive financial losses and delays. Simply running and maintaining all these complex facilities, from power plants to gas pipelines, comes with its own set of operational risks and costs. For their energy resources segment, they're exposed to the roller coaster of natural gas and oil prices. If prices stay low or if drilling efforts fail, it can force them to delay projects or even write down the value of their assets. This is a direct hit to their investments. If the energy markets become less liquid, meaning it's harder to buy and sell energy or related products easily, it makes it tougher for NextEra Energy to manage the risks in its day-to-day operations. If the actual pipes and wires that transmit power and natural gas get disrupted or aren't available, it can stop them from selling and delivering their products, which obviously impacts sales. They use financial instruments called derivatives to manage risks, but if the companies they do business with, their counterparties, don't hold up their end of the deal, or if they have to put up a lot of cash as collateral unexpectedly, this can lead to financial problems. Cybersecurity is also a major concern. Any failure or breach of their IT systems, especially if customer data is compromised, can lead to massive problems, both financially and in terms of customer trust. FPL operates under franchise agreements with local governments. If they can't negotiate acceptable new agreements or renew existing ones, it could disrupt their ability to operate in those areas. Operating nuclear power plants comes with a unique set of risks, including environmental, health, and financial liabilities. If something goes wrong at a nuclear plant, they could face huge costs for cleanup or special insurance premiums. Also related to nuclear power, if they can't operate these plants for their entire planned lifespan or get extensions on their licenses, it means they might have to shut them down sooner, impacting their energy supply and finances. This is a big one for any company that needs to borrow money. If credit markets are unstable or uncertain, it can become difficult for them to get the funding they need to operate and grow, potentially impacting their ability to pay bills or invest in new projects. Many large projects use specific types of financing where the debt is only backed by the assets of that project. If those projects don't perform as expected, or if there's a default, it can cause significant financial headaches. If the banks or financial institutions that have promised to lend them money can't or won't, or if their own credit ratings drop, it can severely impact their ability to get cash when they need it. They also have pension plans and funds set aside to decommission nuclear plants. If the markets perform poorly, the value of the assets in these funds can drop, potentially creating shortfalls they'll have to cover. This talks about how money flows within the larger NextEra corporate structure. If their subsidiary companies can't send money up to the parent, or if the parent has to step in to cover subsidiary debts, it can affect NextEra Energy's ability to pay its own bills and dividends to shareholders. This is a standard disclosure for dividend-paying companies. It basically says the board of directors decides when and how much dividend is paid, and shareholders shouldn't assume a certain payout level. There's a mention of XPLR infrastructure, and if they can't get money on good terms, it could affect their ability to buy more companies and also impact the value of NextEra's investment in them. And finally, they reinforce that shaky credit markets can hurt their stock price, and obviously things like pandemics can have a massive impact on their overall business. This filing also lists the exhibits, and the most important one here is Exhibit 99, which is the actual stipulation and settlement agreement itself, dated August 20, 2025. And of course, Exhibit 101 contains the interactive data files formatted in something called inline XBRL, which is how modern companies submit their financial data to the SEC in a machine-readable format. Exhibit 104 is the cover page interactive data file, also in inline XBRL form. Looking at the signatures, we see top finance votes like William J. Goff for NextEra Energy and Keith Ferguson for Florida Power and Light Company signing off on this report. It shows these significant financial and operational plans are being officially acknowledged and reported. So what's the story here? Florida Power and Light is proposing a significant rate increase, which is to be expected in utility rate cases, but they've managed to reach an agreement with many of their customer groups, which can be difficult to achieve. This agreement includes substantial revenue increases over the next few years, but also includes some customer-friendly provisions like sharing profits and capping interim storm cost recovery. The company is juggling a lot of risks, from environmental regulations and clean energy policies to market volatility and cybersecurity. The success of this plan hinges entirely on the approval of the Florida Public Service Commission, and their decision by January 1 of 2026 will be critical. Now, let's look at this from a different angle. A bit like how Warren Buffett might. FPL is essentially asking for permission to earn more money, and they've struck a deal with a good chunk of their customers. The proposed rate increases are substantial, but not entirely out of line with what utilities often seek. The fact that they have agreement from 10 out of 13 intervener groups is pretty good negotiations work. The key for investors and customers is to watch that. Regulatory ROU utility, but the focus on clean energy incentives and emissions limits shows where the future pressures and opportunities lie. They're navigating a changing energy landscape and their ability to adapt and secure favourably regulated utility, but the focus on clean energy incentives and emissions limits shows where the future pressures and opportunities lie. They're navigating a changing energy landscape, and their ability to adapt and secure favourable regulations will be key to their long-term health. What % target? That's their guided profit margin if they consistently hit the upper end of that range, or even exceed it. Alright, that's our breakdown of the Florida Power and Light and NextEra Energy filing. What's your take on these proposed rate changes and what they mean for customers and investors? Let us know your thoughts in the comments below. If you found this analysis valuable, please hit that like button. It really helps the channel out, and don't forget to subscribe for more deep dives into corporate filings. Also, join our Discord community. The link is in the description. Thanks for watching, and we'll see you in the next video.